Welcome, everybody, to the High Return Real Estate Show. I am super excited. I'm here with my amazing and fantastic and recently visited business partner, Mr. Jack Gibson, who graced us with his presence at a fun party that we had the other day. How you doing, Jack?
I'm doing great, Chuck. You know, Ruth's Chris Steakhouse in Indy, if you've never been there, well, if you've never been to a Ruth's Chris in general, you got to go. We had a fantastic team dinner, didn't we?
Yeah, it was great.
It was amazing.
So, anyway, I'm excited because we've got on our show today I know we talk about the sort of the byline for the High Return Real Estate Show is the podcast for heavy hitters. Today, we have got a heavy hitter on our show. And so I'm really, really excited about that. And I'm sure that you have heard his name. I'll just withhold his name until after the break, but we're just going to take this little pause, and then we're going to come back and bring on our very, very special guest. Welcome to the High Return Real Estate Show, the podcast for heavy hitters. 2 men, 1 mission. It's time to build your empire. All right, welcome back, everybody, to the High Return Real Estate Show. Again, I'm here with my amazing friend and business partner, Mr. Jack Gibson. And today we have the world famous Mr. Jason Hartman on our show. Hello, there he is popping into the screen. How you doing, Jason?
Hey guys, good. I've never done an entrance like that on Zoom before. It was a first.
Yeah, it's great. We're happy to have you. And if you don't know the name Jason Hartman, Jason has been in the game for a very, very long time and runs probably, I would say, maybe arguably one of the largest referral networks for investors looking for rental properties probably in the world. And so you've been doing that a long time. Tell us a little bit, Jason, just about your history and how you kind of got into that and how it got to today.
Sure, absolutely. I got started in the investor-only side of the real estate business back in 2004 as I was negotiating a deal to sell my traditional real estate company in Irvine, California to Coldwell Banker. And that negotiation, publicly traded company, complicated. It took about a year to do. Mm-hmm. And I was looking around for something else to do. And I thought, I have a non-compete that I can't sell real estate locally unless I do it with them for a certain amount of time. And the reason I got into the real estate business back when I was 20 years old, well, I was really 19 years old. It was 2 weeks before my 20th birthday. I was in my first year of college, and I always loved income property. I always thought it was the most historically proven asset class. Mm-hmm. I saw an infomercial back when I was 16 years old before that, and really got interested. And I started working with investors. I worked at RE/MAX for many years. And then I did the traditional real estate thing for many years as well, helping people buy and sell their personal residences. But I always loved the investment side. And I knew as I was negotiating that deal with Coldwell Banker that I'd have a big check coming in when the deal closed. And I was thinking, well, how am I going to invest this money? What am I going to do next? Should I just retire? And I'm really not fond of the idea of retirement, although interestingly, that's what I kind of help people do. But I think retirement is really doing what you want to do, not what you have to do, right?
That's right.
I don't really believe in retirement because I don't think it's actually good for people. I don't think it would be good for me. The idea of sitting on a beach somewhere is insanely boring to me.
That's right.
I like working. I like producing value in the world. So, I thought, well, I'm not going to retire. And I started looking around as to what I'm going to do with this money. And I started doing the traditional thing that pretty much every American does, or every person around the world does. They go to a financial planner. I went to a whole bunch of them. I used this time for this year of negotiations with Coldwell Banker to think, what am I going to do? And all of these, I went to all these, private client groups at all these financial services firms from Merrill Lynch, Ameriprise, Charles Schwab, all the rest, right? And then I talked to exit planners, and they all basically said the same thing. They printed out a really nice little report with some pretty colorful pie charts, and they basically were following what's called modern portfolio theory, right? And they said, in this slice of the pie, we'll have some small cap, and here's some large cap, and here's some international stocks, and based on your age, we'll have a little bit of bonds in your portfolio. And this is crap. Nobody gets rich by this, right?
Right.
And you know, I'm always sitting across the table from a guy wearing a nice suit who went to a good school, but it just doesn't work. You know, basically what Wall Street does is it helps separate people from their money. You know, and it's an insider's game. I call Wall Street the modern version of organized crime.
Oh, wow.
And, you know, so I thought, what am I doing? I'm a real estate guy. I bought my first rental property when I was 20 years old. I've made a fortune buying and selling my own real estate and renting my own real estate and helping other people buy real estate. Why am I talking to stockbrokers? You know, so I just had this like epiphany. Like, what am I doing here? I think that was when I walked out of the Charles Schwab office in Newport Beach. That kind of hit me, and so I then started researching markets around the country, and I read, you know, the Places Rated Almanac, all of the typical things that we've all heard of, all of these, you know, best cities for this, that, you know, cities ranked and rated. I started, you know, spending a lot of time on the US Census website and doing research, right? Because I didn't want to go through another undiversified change in the economy. And I knew that change was coming. Remember, this was 2004. Okay, so I could see it coming. I could see the market changing because all of these people were buying homes that were far more expensive than they could really afford. Lenders were, I owned a couple of mortgage companies over the years, and I saw the kind of ridiculous non-underwriting guidelines. I mean, they were giving loans to anybody. You know, if you fog a mirror, you got a loan. It was absolutely stupid. No one in that whole system was putting the brakes on anything. Everybody was incentivized to make more loans and give more money in the hands of people that just couldn't afford the houses they were buying. And so I knew that was going to come to an end. That was just a silly whole party that was going on. And so I didn't want to be all in one market. And I noticed over the years, like back in the mid-90s when I was in traditional real estate, there was one point when Orange County was having a really tough time, Orange County, California. They declared bankruptcy. You might remember Bob Citron bought a bunch of derivatives. He was the tax collector that was in charge of investing the property tax money and so forth. Anyway, I remember at one point I had 38 listings, and exactly half of those listings were vacant, where people had literally just abandoned their homes. And I was left to try and work out short sales with their banks before they went into foreclosure. And the places they were moving to were these linear, boring markets. Now, just so you know, I basically look at the world that there are basically three types of real estate markets, only three. That's it. You can classify the entire planet into three types of real estate markets: linear, cyclical, and hybrid.
Okay.
Three types. Okay.
So Tell us more. This is cool.
Yeah,
I haven't heard this.
I want to hear more.
Yeah.
So I had spent most of my life in a cyclical market. I was in the very high-end area, you know, Irvine, Newport Beach, Orange County, California. Beautiful place to live, a very, very expensive place to live. You know, it's kind of the Silicon Valley of Southern California, right? And I had spent my whole life in that type of market, a cyclical market. And a cyclical market just basically has glorious highs and really ugly lows. It has this, the graph looks like this. It's a roller coaster, okay?
Is this a lot of the coastal markets? Are they, would you consider cyclical? I mean, you're talking like East Coast, Florida, you know, Toronto. Toronto seems like that's great.
You got it. Yeah, okay. You nailed it. Okay, so cyclical markets are basically the entire west coast of the United States, the expensive northeastern part of the United States, whether it be Washington, D.C., New York, Connecticut areas, you know, the really expensive areas, Boston, et cetera. And then South Florida, where I live, okay, is a cyclical market. And then around the world, they would be places like Toronto, Vancouver, Canada is the poster child of cyclical market.
Oh yeah.
You know, Toronto, Montreal, you know, London, Dubai, Hong Kong. All of these trophy cities are the cyclical markets. They're the high flyers. They're the ones that get all the news, they get all the attention. Yet there are much better places to invest. In those markets, you are a gambler. You are a speculator.
Yeah.
Okay? Because nobody, at least in my career that is now spanning several decades, I hate to admit, but it's been a long time. In my career in real estate, I have never met anybody who can reliably predict the cycles in appreciation and depreciation. Okay? Yet cash flow, on the other hand, rental income in good linear markets, and the examples of those would be Indianapolis, Memphis, Little Rock, Arkansas. There are many others around the country. In fact, all of the rest of the country that I didn't mention before in terms of cities is either linear or hybrid, and most of it's linear. So I'll just tell you the hybrid markets, and then the rest is all linear pretty much, okay? Hybrid markets are places like Denver, Austin. Now, one of you used to live in Austin, I know, okay? Denver, Austin, these are sort of these creative class cities. Atlanta has become a hybrid market. It used to be linear. Phoenix used to be linear, now it's hybrid, okay? And those markets are in between the two. So the linear markets, if you look at the graph, they just kind of chug along, you know? They have little ups and downs, you know, but they're not significant. They're not like that, okay? Not like a roller coaster. They're minor fluctuations, okay? Hybrid market is in between the two. So fluctuations on a graph, if you're looking at the video, they're like that, okay? They're in between the two, as the name would imply. And so cash flow in linear markets is very reliable, you know? We have been in Indianapolis. That is our longest running market. And we've been in many markets around the country over the last 15 years. But Indianapolis is our longest running market. Very linear, and I'll say it, very boring. Boring is good when you're an investor.
Right.
Boring is not volatile. It's consistent, it's reliable, you get good cash flow, and cash flow is reliable. It's not perfect. You know, renters, sometimes they don't pay. Sometimes you have to evict them. Sometimes they thrash your house. Absolutely, that happens. But it's rare. It's not the norm, okay? It does happen, though. But appreciation and depreciation, very unreliable, very hard to predict. You've got to follow my 10 commandments of successful investing. And so I'll share a couple of these with you.
Well, I was going to ask the whole question and just give us all 10.
Yeah. Well, all 10 I don't have time for probably, but here's a couple that are helpful, okay? And, you know, if you want more, my podcast is available, jasonhartman.com. It's all there. Cool. But commandment number 5 is what we've been alluding to here. And commandment number 5 is, thou shalt not gamble. Thou shalt not gamble. And what that means is that the property must make sense the day you buy it or you don't buy it, okay? If you buy something that does not make sense from day one, you are a speculator, you are a gambler, and, you know, look, I don't want to say never do that, because if you've got some wealth, you know, you can afford to use 5, 10, 15% of your wealth. It won't hurt you if you lose it, right? You know, but you might hit a home run, okay? So I understand that concept, that you might hit a home run. So, you know, you might gamble a little bit, okay? But it shouldn't be the core strategy. Sure. So thou shalt not gamble. The property must make sense the day you buy it or you don't buy it. How do you know if it makes sense?
That's the question I was just going to ask.
Yeah, good question, Jack. So how do you know if it makes sense? Easy. Cash flow, right? And what I mean by that is you really look at this by the rent to value ratio, or the RV ratio. And ideally, we want to achieve somewhere in the neighborhood of 1% RV ratio. Very simple rule of thumb calculation. If the property is $100,000, you want to get $1,000 a month gross rental income. So 1% of the value each month, okay? We want to assume that you're going to have 1 month vacant every year, an 8% vacancy rate, essentially, 1 month per year. And we make some other very conservative assumptions on our pro formas, and anybody listening can go to jasonhartman.com, click on the properties section, and see these pro formas with all these assumptions. 1% of the value per month in that neighborhood, you're buying a property that makes sense. Okay, so very easy to know if you're doing that. Thoughts, questions?
Or what are some of the markets in terms of the 1% type rule that you're alluding to here? What are some of the markets that you see that, you know, investors are consistently getting that or better?
Yeah, well, nowadays, now that it's 2019 while we're talking, not too many good quality markets and good quality properties are achieving more than 1%. If you asked me that question in 2009, 10, 11, or 12, we had lots of properties that would do that, okay?
Right.
But nowadays, it's pretty hard to do that. Now, I know that you guys specialize, and the important key word there is specialize, right, in the C-class properties. And those properties, if you are a specialist, can do very well, and they can achieve better than 1% RV ratio, okay? But for most people that want to do sort of an arm's length, sort of remote control type of investing, right, where they're not experts, they're not paying attention to it real closely, and, you know, generally speaking, and this isn't always true, nothing is always true, but mostly it's true, a better quality property will get you a better quality tenant, okay? Now, your rent-to-value ratios won't be as good, but you will get a better quality tenant most of the time. Look, you can have an A property and get a D-class tenant, okay? It certainly happens.
Yeah.
But by and large, not, okay?
Yeah, that's great.
So in terms of the markets, you asked that question, you know, Dayton, Ohio area, Cincinnati, Ohio, Kansas City, Indianapolis, okay? We talked about Indianapolis. The Quad Cities area can do it. Jacksonville, Florida can do it. Memphis, Tennessee, Jackson, Mississippi, you know, Fayetteville, North Carolina, not Arkansas. You know, there are lots of markets that can achieve that, where you can buy good quality properties and get in the neighborhood, give or take, of 1% per month. And the important thing to understand is prices of properties always react faster and fluctuate more to market conditions than the rents do. So it's always a game of catch up. Right now, the cycle we're in is we've seen a lot of appreciation over the last 8 years, and the rents never keep pace. They always lag the appreciation cycle, okay? So basically what we're seeing is now it's much harder to achieve those good rent-to-value ratios because the prices have gone up so much. But what will probably happen now, and here's a little bit of a prediction for you, is we'll probably see prices soften a bit, or at least level out, and then the rents over the next few years, as prices are soft, will start to catch up and increase. Because I call this the 3 dimensions of real estate, and really there's more than 3 dimensions, but it's a good name people will remember, right? And what we have is we have these 2 items of price of property and rental income of property. They are non-correlating things. So when prices are going up sky high, rents usually soften, because all of those renters, if they can do it, are jumping into the buyer market. They want to become homeowners because prices are going up like crazy. But when prices aren't doing that, and you know, there isn't that urgency to buy with this fear of loss, that, you know, the FOMO, fear of missing out, right? Yeah. Where they might miss out and they fear losing, then they will generally sit on the sidelines, and then the landlords can raise rents because there's less demand for purchases, less people are moving out of the renter pool. And as long as the population's increasing, hey, you know, investors are going to win. That's just always the case.
Yeah, that's interesting. I'm curious to know, I mean, I love the 5th commandment. Would you throw one more at us?
Yeah. You know, one that's really resonated with a lot of people is commandment number 3. And commandment number 3 is, thou shalt maintain control. Thou shalt maintain control. And what that says is that you should be a direct investor. When you are investing your hard-earned money, the money that you have saved, you have delayed gratification to save this money, you have given up vacations, a new wardrobe, a nice new car, remodeling your house or a more expensive house, you've given up all of that, right? You've delayed gratification. And in doing that, you should not relinquish control of your hard-earned money to somebody else. Now, when you are not a direct investor, when you do not maintain control, you leave yourself susceptible to 3 major problems. Number 1, you might be investing with a crook, okay? So Mostly this happens on Wall Street, but there's certainly enough crooks in real estate, okay?
Mhm.
And what I mean here is when you pool your money in anything, in a stock or a mutual fund or a real estate deal, like an LLC or a partnership that's set up, right? When you do that, you give control to somebody else, to a syndicator or a promoter of some sort, right? Or a sponsor, a deal sponsor. And they have control. They decide what to buy, what to pay for it, how much to compensate themselves. They decide if they need to take first-class trips to go look at the investment or go to a conference that happens to be in Hawaii or the Cayman Islands or whatever, right? And they're doing that a lot of times with your money, okay? But they might just be outright crooks, like Bernie Madoff or the guys at Enron or WorldCom or Global Crossing. I mean, you know, the history books are replete with these examples of criminals that take people's money, right?
Yep.
So the first problem is you might be investing with a crook. But let's assume you invest with someone who's honest. That's good news. You passed one hurdle. Well, you might be investing with an idiot. Okay, so they might lose your money because of their sheer crookery, but they might also lose your money because of their sheer stupidity. Okay,
Yeah.
Either of those are bad. Okay, so assuming they're honest and competent, now we get to the third hurdle. They take a huge management fee off the top for managing the deal, right? And I'll just give you one example of this. It's a Wall Street example, but it's a famous person we all know, and that's Larry Ellison, the founder and CEO of Oracle, right? Oracle, he's a billionaire, and Oracle is a huge company we've all heard of, right? Between 2000 and 2002, in 2 short years, Larry Ellison, his take from Oracle, and forgive me if I get these numbers slightly wrong, but they're close enough for government work, as they say, was like $780 million. In 2 years, he took almost $1 billion out of that company in 2 short years. Now, look, that would be fine if all his investors were making a fortune too. But during that same 2-year period, the shareholders, the people who put their faith in Larry Ellison and his company, they lost 61% of their investment. Okay? And this is completely legal. There is no law against that.
Wow.
You know, he can pay himself giant bonuses and comp packages and whatever, while the investors lose all their money. Okay, he took almost $1 billion, while his shareholders lost 61%. That is not a good deal. So, thou shalt maintain control, commandment number 3.
Yeah, I think that's beautiful. And, you know, to a certain extent, at least with us two, you're kind of preaching to the choir, as you can imagine.
Yeah.
And
I am, but the choir may not be listening. I know you guys are the choir,
yeah.
but not all of your listeners are the choir.
But hopefully all the investors are taking note. And, you know, obviously, you know, the 3 of us are essentially all in one version or another in the same business. And that's to put investors in a situation where they don't necessarily have to spend their whole day maintaining control, obviously, because we do a lot of turnkey stuff, but they do own the deed to the property and can make decisions about whether they're buying it or not, buy, sell, and, you know, even decisions as far as, you know, who's managing their property and things like that. So
absolutely. You know, that's such a good point you make, Jeff. I mean, look, you know, with income property, when you are a direct investor and you own the income property, you decide what to buy, where to buy, when to buy, how to finance it, when to refinance it, when to sell it, whether or not you want to do a 1031 exchange. You decide how much rental income you want. You decide if you want to improve the property to gain more rental income. You know, you're in control. But look, with control, what comes with control? We all know, right? Responsibility, right? So you, your company and my company basically take some of that responsibility off the shoulders of the investor. They still have to pay attention to it. And you know what? I want to say something else. And this is not a commandment, but it's something I've said for 14, 15 years now. Don't be deceived, listeners. There is no such thing as a passive investment. That is bogus. That is just not true.
Right.
Any investment where you're going to have a good experience, okay, you better pay attention to it. If you're a stock market investor, you better read the Wall Street Journal. You better keep up on the news. You better read books about it, whether you want to be a Benjamin Graham type investor and use fundamental analysis, or you want to be a chart person and understand the charts and what they tell for the future of that stock. You better decide if you want to be a dividend investor or a capital gains investor. You got to decide, when to take tax losses on your stocks and when to harvest gains. There's a million things you better be paying attention to. Okay. Sure. There's no such thing as a passive investment. It just doesn't exist. It's a myth. So anybody that tells you that real estate investing or anything else for that matter is passive, it's simply not true.
So there's definitely degrees of active in versus passive investing, right? But the way I always think of it is, like you said, there is no passive investment because there always takes a team of active people
right.
to run the business or run the real estate property or whatever the case that you're investing into, right?
Yep.
So, but I totally agree. You can't take like total, hey, I'm just going to wipe my hands of this and just totally trust 100% to somebody else to look after my money.
Right.
You're saying stay in control.
You've got to have a team and you've got to manage the team. You don't have to do everything directly, but you do have to pay attention to what the team is doing.
That's right. That's good.
Yeah.
Absolutely. Love it. So I'm looking at the clock behind me and seeing that we're running out of time, but Jason, I love having you on the show, man, because you're just a wealth of wisdom, and it's greatly appreciated, the stuff that you share.
Well, hey, I went to the school of hard knocks, okay? Yeah. So I've made my mistakes, and I've paid for them, and I just hope to, I say to other investors, learn from my mistakes rather than making them yourself, okay?
So I have one more question before we wrap up, because you got into the three types, the linear, the hybrid, and the cyclical markets, right? So where we're at right now, we're recording January 2019, right? Mm-hmm. Where do you see the three different markets overall?
Great question. Question. Good, Jack. So the cyclical markets have been overvalued for many years, and now they're finally crashing. Okay. So those markets are a disaster.
When you say crashing, are we talking 10, 20, 30% drops?
Well, not yet.
Not yet. Okay. You're just saying they're on their way down.
Yeah, but I'll give you an example from ridiculous New York City. Okay. I just read an article yesterday that I'm going to talk about on my podcast and kind of dig into it and take a deep dive that New York City's, I think it was New York City's median price is now under $1 million. Okay. And that's like bad news, right?
Yeah.
It's a big deal. Markets are very soft in especially the higher end markets of Los Angeles, New York City, Seattle, Vancouver. I mean, these markets are really softening and things are changing. There's no question. This will trickle down, okay? And the next will be the hybrid markets that start to feel a little bit of that pain. And the last will be the linear markets. And it has to get pretty bad for the linear markets to feel that pain. And as you guys recommend, and I agree with completely, buy properties makes sense the day you buy them. Commandment number 5, thou shalt not gamble. Because we don't even care about appreciation. Hey, look, if appreciation happens, I can spend it as well as the next guy. Okay, it's the icing on the cake, but it's not the cake. The core of the business is return on investment. It's simple ROI. And if the property goes down in value by 30% and you maintain that same income and expense ratio, who cares? You're not selling anyway. We're in this to buy and hold, for a long, long time. And when we sell on a 1031 tax-deferred exchange so that we don't pay taxes. That's another thing. In the stock market, you pay taxes when you make a move. In real estate, you can trade it all your life and defer, and then you can die, and the basis steps up to market value when it's inherited. It's the best deal ever. It's the most. One of the commandments is thou shalt only invest in tax-favored assets. And income property is the most tax-favored asset class in America.
Mm-hmm.
Yeah. Love it. Love it. So I'm very appreciative, especially the discussion of linear, cyclical, and hybrid, because that really even for old dogs like us, that tends to clear things up. Old dogs like me, Jack's still a young buck. But it just helps to clarify things, and it really helps us to understand what we're doing in relation to other markets. And I think it's great for the investor to understand when they go out and look at markets, what are they truly looking at? And we're 100% in agreement that it's very dangerous to mix the appreciation conversation with just good old, does it make sense today? Cash on cash ROI, let's rock.
Right.
Is this thing making money right now?
Yeah.
My other contention for the future has always been this, and this is notwithstanding appreciation or depreciation. And maybe I'm greedy, but I want my money right now. I want it every month. And here's why, is because we live in an incredibly inflationary society. And as long as U.S. government continues to print money,
yep,
and as long as confidence in the American dollar continues to decrease with things like Bitcoin and other digital currencies, we're going to be in a situation where we're going to see increased inflation. And all that means is that the spending power of that money continues to diminish with time. So if you're banking on making a bunch of appreciation in said time, you also better damn well factor in that reduction in spending power into that appreciation. And I think
income property is the best hedge against inflation in the entire world.
Yeah.
Absolutely.
Have me back on your show sometime, and we can spend a whole half hour talking about my concept of what I call inflation-induced debt destruction. Okay? Where basically inflation pays off your debt for you. It's the hidden wealth creator in income property that very few people are talking about, and I've been espousing it for many years. Your tenant is basically paying your debt back for you in ever cheaper dollars. So,
yeah, I love it. Definitely. Let's get him back on, Shecky. That sounds great.
Awesome. Well, okay, listeners, ladies and gentlemen, the amazing and wonderful Mr. Jason Hartman. Thank you. Thank you.
I love you guys.
Yeah. No, really appreciate you. And thank you so much for taking the time and sharing your wisdom with us. Really, really great. And Jack, as always, thank you for your leadership and support and friendship. And thank you to all the listeners. Jason, if the listeners want to find you, where do they go?
Just jasonhartman.com. That's jasonhartman.com, or find my podcast on any podcast platform. It's called The Creating Wealth Show. Just search my name and you'll find it. And I want to just say to you and your listeners, happy investing, and we'll talk to you again.
Thank you.
We'll put all that in the show notes as well for the listeners. Yep.
Thank you very much. We'll see you all later.
Thanks, everybody.